Hey New Zealand, welcome back to another great video from Blueprint. Today we're going to look at home and income properties. We're going to understand what to look out for when purchasing a home and income property. We're going to look into the numbers behind borrowing money from the bank when it comes to buying a property with additional dwelling and rental income. And then we're going to understand, if you're an existing homeowner, how the numbers would play out if you were to put a separate dwelling on your land next to your house. So stick around and let's get stuck into it. Alright, so the first thing we're going to look at is what exactly is a home and income property. A home and income property is a legal separate dwelling. You would have the consent for that dwelling issued in the LIM report. So if you're a buyer, you want to look at the LIM report and want to see if a building consent is issued. Now, we've got two listings that we've loaded up and we can quickly see if they are home and income or not. The first listing, we've got a clear title home and income, and this is in Otahuhu, and it's telling us that it's on a big plot of land, a 1950s 3-bedroom with a minor dwelling. From the maps, you can clearly see that there's two dwellings. They do seem attached. And when I search them up on our system here at Core Logic, I can see the category as residential home and income. Versus this property here that is on 32 Green Lane East. It is advertised as a home and income when you click on the home and income tab on Trade Me. And it says that there's an added bonus with an extra large bedroom, ideal for home, office, or granny flat. If I search this one up, it shows me that it's just a residential dwelling. Now, what this means for you is you really want to be going through the LIM report and ensure that it's a legal home and income, because the complications come in when it comes to financing, because the bank is going to want to understand if you're using $700 a week as rental income, whether it's a legal dwelling that is attached to the house or separate from the house, in order for them to recognize that full rental income, even if they scale it back a bit. Many times we see informal splits. These can be slightly risky if your expectations are that you're going to finance it and you want the full rental income recognized. 99.9% of the chance, if there's not enough documentation or supporting documents to prove it is a separate second dwelling or an attached dwelling with its own kitchen, that sort of thing, it's not going to get across the line. So the key takeaway is always make sure that it is meeting the council requirements and check the LIM report. So now that you know what a home and income style property is, how do the numbers look? We're going to compare what someone with a normal property that we're not introducing any rental income to could borrow versus someone getting a minor dwelling after they've done all their checks. So over here, we've got an example. We've got a couple earning $78,000 and $90,000. Assuming there's no rental income coming in, they can borrow about $935,000, and they'll need another $233 on top if they had a 20% deposit to buy a property for $1.169. Now we're going to introduce some rental income. So let's say after you've done your checks, check the LIM report, know that there's building consent, and you introduce $520 as the rental income, they can borrow about $200,000 more. So the rule of thumb is normally about $200,000 to $300,000 more, depending on the bank and their servicing criteria and the policy in place. But this gives you a good idea as what additional borrowing could look like if deposit wasn't so much of a problem and you wanted to get a home and income property. So now let's look at an example where you might already be a homeowner. You've got a freehold section, you've got your house there, but you've got a bit of land on the side or the back where you might want to construct a minor dwelling. In this example, we've got $1 million property that's valued by the banks, and the clients are owing $485,000 against it. Now the rule is that you can borrow up to 80% on the value of your family home, which is $800,000 minus your current mortgage at $485,000, meaning you have available equity of $315,000. You might not be interested in buying an investment property that's an existing property or a new build, purely because you'd rather do the minor dwelling. And when it comes to getting advice on this sort of stuff, look, if it's new build, you're probably going to be cash flow negative. Yes, it's got the 10-year builder warranty and there's maintenance, but if you can build the minor dwelling on the side, it does exceed the new build. However, when it comes to an existing property, it is a very, very different category, and you can buy 6 units on one title, 4 units on one title, and you really need to get into the yield to compare whether building a minor dwelling on your own property is worth it or buying an investment property. But let's get on to this example and assume that we're back to this couple and now they have a mortgage of $485,000. So you can see that if they are able to get an income of 520 rent by building the future minor dwelling, and they have all relevant support documents in terms of being able to get the building consent and get it added onto the LIM, or perhaps they can get conditionally approved for it, the bank is willing to lend them out about $673,000, but they only need 315 of this equity. So when you get this 315 out and you put it into the calculator, and let's say you're borrowing money at 4.99% principal and interest, and you're getting $520 a week from it now, assuming your rates are 3.5, I've increased the insurances to about $1,200 on the second minor dwelling there. You don't have a property manager. You are cash flow positive about $429.62 on the money that you've borrowed, which means your yield is 8.58%, and that is a pretty good yield. Secondly, you've constructed something brand new. What happens to your existing property is that the value over here will also go up. When the banks will look at this property, they will go, okay, $1 million plus 315 to get the property all consented and ready. That's the new borrowing for the build. The property will come back at least the value plus the build cost, which is 1.315. We have seen cases where it comes back at 1.5 mil and people make instant equity. So is it worth it in the long run? Is it better to buy a home and income property at the start versus buying it later or building the minor dwelling later? To be honest with you, if you have the deposit right now and you can purchase a home and income property in a major city, it is 100% the move that you should make. However, if you don't have the affordability, or perhaps you can buy a dwelling with a big enough section to have a future plan, that's really good as well. There's no correct answer because everyone's financial position is different. But if you're waiting it out and you have the deposit and you buy something normal with a plan to do it later, be aware that the build costs will increase compared to buying something right now that's already a home and income style property. Please do all your checks and make sure that the LIM report and the building consent are all in order. And I hope you guys found value from this video. Our goal is to give you the best value when it comes to planning out scenarios. And if you do need to engage with us, or perhaps just jump on a call, do reach out to us at blueprintfinance.co.nz. We're waiting to hear from you.